How do you get rich? Let's talk about it. So the simple idea is own equities if you want to get rich.
The portfolio bank that we built from the start of Cube has now expanded. We started only with mutual funds. And our second speaker today, Premal, is the founder of Wealth First. That's who we started with. Today, we have over 12 types of assets, including the ability to invest in US markets with a US brokerage account that you set up through the Cube application. Let me talk a little bit about what is Cube's mission. It's very straightforward. We want to make hardworking, deserving people wealthy. It's as simple as that. The problem is for all of us that we don't know how to invest, who to trust, and how to figure out the time to track our portfolio and build it over time.
The way to become rich is by owning businesses. How do you own businesses? By starting some businesses or inheriting some businesses. But if you don't have the caliber, if you don't have the wherewithal, if you don't have the capital, and also if you don't have the acumen, expertise, or inclination to start a new business, then what do? Simply, somebody else has started a business which is doing phenomenal, which is doing brilliant, just own a portion of it. That real estate is a great way to make money, phenomenal. But look at the developers. They don't make too much money from the real estate. They make money by owning equities of those businesses, of those companies which manufacture real estate and sell real estate. But the problem is equities are risky. Equities are volatile. You can have potential loss of principal in equities. We recently saw in the month of March specifically, the markets were down almost 42% from the peak, right? So what do? But most people will not go for this gambling because they will believe that if I lose the money, then I'm losing 50,000. On the hindsight, they are not seeing if they can make potentially 1 lakh rupees, which is 2x. What does this imply? It implies very simple thing. We value things more what we already have as compared to what we don't have. And that is the simple reason when after investing in equities, because of the external factors, if markets pull the equities down, we get panic because we believe that our notional loss is a loss of principal, and hence we start reacting negatively. It's a mark-to-market loss for the time being because of the external situation. And as soon as the situation normalizes, and we all understand that everything prevails to the law of averages. So as soon as the average will come back, you will recoup and make more money. So what you need to be doing is being patient during tougher times or investing more. But our psychology gets into the mode of fear. And since it is fearful, we start exiting, booking those losses. And as soon as we book those losses, our notional loss actually become the real loss. And we lose the opportunity to create wealth for ourselves. And why do people do not, despite of knowing the fact that that's the simplest way to make money, why do people do not invest? Because unless you are aware of your problem, you will never be able to overcome it. So the first thing is the realization of the problem. So as I explained to you, that endowment effect helps you to understand that loss, which we believe is ours, restricts our ability to look beyond. And that's what is needed while investing in equities. Incremental 5% or 10%, the gentleman lost, the Yahoo shareholders lost almost 85 to 90% of the value along with the time value of money. And that's what is in the common parlance is known as anchoring effect. What does anchoring effect means? It essentially means that we rely on the first piece of news which comes to us, and we make that as the base. We make that as the base to derive any decisions. It happens in life, it happens in investing, it happens in equity investing. And a call to a friend and you discuss about this, you meeting this person, and this friend tells you 3 bad things which has happened with him or with his friend's friend because of this gentleman. So very simple. You have not even spoken to this man. You have not even met this man. Just because somebody else who had a bad experience, you have already created a negative picture of this person. And for whatever reason this person is going to come, things are not going to materialize. And exactly the same thing happens in equity investing. More often than not, as soon as the price of a stock reaches 52-week high or reaches nearly all-time high, we start believing that it's over and done with. The propensity or the force which the stock has to generate is over and done with. Because we believe as soon as the price has hit 52-week high, it means that there is a guarantee that the price is going to come low. We don't understand 3 very basic simple things. That equity markets are driven by 3 simple things. The first, earnings per share or the PAT, profit after tax. Higher the profit after tax, higher the valuation of the stock or valuation of the company. If your company is making 100 crores of profit and the valuation it will have as 1,000 crores, next to next year, after 3 years or after 4 years, if the company is making 200 crores as PAT, ideally in normal circumstances, the market cap should become 2,000. But we start believing as soon as the market cap has hit the 52-week high, which in today's scenario is 1,000 crores, we start booking profits. Another thing which we do is we keep averaging our losses. We cut our fastest horses fast and we keep averaging our losses. And let me explain to you. So whichever stock is doing very, very well, what do? We try and book profits way too early. While the stock which has been languishing month after month, year after year, as soon as it falls down, we try and average more. It falls down, we average more. And I'll use a very simple example, very, very simple example, and you can see you do it on a day-to-day basis in your life. Imagine you have bought 2 simple stocks. One stock, A, which is worth 100 rupees, B, which is also worth 100 rupees. After 3 years, the 100 A stock became 100 to 200 rupees. Whilst after 3 years, that second stock from 100 became 80 rupees. So your total portfolio value, which you have invested 200 rupees, is currently at 280. Very, very simple. 100 plus 100 you have invested, and today your portfolio value, first 100 became 200 and the second became 100 to 80. So your total portfolio value is 280. Very, very basic, simple thing. After 3 years, you need to pull out 50 rupees. You need to pull out 50 rupees. What are you going to do? Very simple. You will go on stock A and you will skimp out 50 rupees. So your 100 rupees will become 150 in the first stock, whilst your 100 rupees of 80 will remain. The challenge is that's exactly what human psyche does. We constantly keep cutting our fastest horses' legs, and we keep avoiding booking any losses. In fact, if you have additional money to deploy in the fourth year, there's a high probability that you will not invest in stock A, you will invest in stock B, which in 3 years from 100 has become 180. And this is known as the value trap. You keep believing that if you have bought at 100, then there's more value at 80, and then there is more value at 50, and then there is more value at 30. And you keep pumping more and more and more and more money, and you keep losing more and more and more money. While the stocks in the portfolio which are doing well, you will keep cutting those stocks way too early, not allowing them to compound. So that's the second biggest challenge why people lose money in equities. The first thing is they have the fear of loss. In second, because of this cognitive bias, which is known as anchoring effect, you tend to take wrong decisions. And the third and the most important is the concept of butterfly effect. And let me show you some data on that. It's very, very interesting. So all of you guys can see a picture on your screen. This is one of the most decorated players in the tennis history. And if some of you understand tennis is a very simple, very simple game. To win a tennis match, you have to win sets. So for men's, there are 5 sets and you have to win 3 at least out of them. For winning the sets, you have to win games, and to win the games, you have to win the points. So very, very basic. And Djokovic, which is a Serbian player, he is one of the most decorated players, and he has won all the 9 of the Masters 1000 tournament, and still reigning #1 in the world. But what is more interesting about Djokovic's life is, in 2004, Djokovic was 682 as per the ATP rank. In next 3 or 4 years, he became #3, and after that, for a decade, he has been #1. Interestingly, when he was 682, he was earning nearly $300,000 per annum. As he became #3, he started earning $5 million per annum in the ad money, in the sponsorships, in the endorsements. In 2018, he was earning almost 3x, which is $14 million per annum, which is logical because he was the reigning champion. He was the ATP #1. Interestingly, this statistics also is not very alarming, right? Because when he was 682, he was only winning 49% of the total matches. As he became #3, he was winning 79% of the total matches. And as he became #1, he was winning 90% of the total matches he was playing. Nothing alarming. But the interesting thing is, and I'm repeating again, to win matches, you need to win sets. To win sets, you need to win games. To win games, you need to win points. So ultimate objective is to win points. Interestingly, when he was 682 rank in ATP, he was winning 49% of the total points he was playing for. So 100 points and he was winning 49 points. As he became #3, he was winning 52%. So see this change, 682 to 3. Whilst the number of points he started winning were barely 3% incremental. Small change, big impact. Small change, big impact. And to become #1, he just needed to focus 3% more, just 3% more. So by winning 55% of the total points he was playing, he became number one in ATP. And he increased from 49, which is barely 6% jump. He increased his earnings. He increased his earnings by almost 100x. And that's the potential if you own right kind of companies. And this is known as the butterfly impact. And what does the butterfly impact or the chaos theory says? If there's a butterfly which flaps its wings in the northern hemisphere of the world, in the southern hemisphere, there can be a tornado. And that's the ripple effect. That's the domino effect, which we call. And exactly the same thing happens in equities. So what should one be doing while investing in equities? 4 very, very simple things. Invest in businesses which are clean and consistent. And what does that mean? In a very layman terms, very, very simple. Buy businesses which do not have any crony capitalism, which do not have any political linkage, which do not have any bureaucratic linkages, which do not drive home the point that any external environment is giving them strength rather than their own DNA. So the businesses which thrive their strength from their own DNA are the ones which create humongous amount of wealth. Consistent basically means not lumpy growths. So you should rather prefer a company which is giving you a revenue growth 8 to 10% year after year after year after year, rather than looking for a company which has given in 1 year 80% revenue growth and after 5 years flat. You should pick up a company which is growing PAT or profit after tax or EPS 12 to 15 to 16% year after year after year, rather than looking at businesses which have delivered profit after tax of 70-80% in 1 year and then negative growth for next 3 or 5 years. Second very, very basic check is that you should try and pick up businesses which are lowest in the consumption basket. Your biscuits, your milk, your noodles, your baby food. And you can see today also, the world is coming to an end. There's COVID all around. There are over 33.5 lakh cases worldwide. It's a pandemic. People are fearful. People are staying at their house. Despite of that, you're bound to consume these businesses day in, day out, because irrespective of the market, irrespective of the external environment, irrespective of the economic downturn, irrespective of the medical challenge, you are forced to consume these businesses. And as long as 137 crore population of India is gonna continue to consume these things, there is no looking back. These are the businesses which are gonna grow year after year after year after year. It will not matter where, what is the valuation. It won't matter. It won't matter that how fast they are growing. Sometimes they'll grow at 13%, sometimes they'll grow at 16%, but they will never disappoint you even with a single digit growth. And those are the businesses which you should look at. The second very important thing, buy businesses which have dominant market share. So imagine, so think about it. India broadly in last 72 years of independence has still over only 2.5 to 3 companies which dominate the four-wheeler market. 85 to 90% of the sales in the four-wheelers, passenger vehicles, come from only 3 companies. Two-wheelers, again same thing. Biscuits, 85% of the total industry is controlled by 3 players. Paints, 95% is controlled by 3 to 4 players. And then there is a long tail. You don't have to care about the tail. You have to invest into the market leader. You have to invest into the businesses which have moats, which have inelastic demand. And that's a little more technical, but in a very basic layman terms, buy businesses which are B2C, which are lowest in the consumption pyramid, which have dominant market share, the leader in their business. And the most important, which takes over everything else, is unleveraged balance sheet. Please, please, please do not invest in any company which has even an iota of debt on their balance sheet. There should not be any debt on the balance sheet of businesses. And if you're investing in those, remember that you will be prone to cyclicality. Because the problem with the leverage is very simple. When people take loan or borrowings, they have a certain margin in their mind. So your margin in the business may be 10% and your cost of borrowing is 8%. The problem is the cost of borrowing is not determined by the business. Cost of borrowing is determined by the external environment. You do not have control on it. If a pandemic comes, if an ILFS issue comes, if 2008 again comes, if 2003 comes, if 2000 comes, if there is a currency war which comes, if there is a trade war which comes, the cost of borrowing keeps moving up and down. That's one. Second is, India is a capital deficit country. We have a fiscal deficit which is very, very large, And this has been there because we are a developing country, we are a growing country, we are a fast growing country. Hence, fiscal deficit is there. And if I put state fiscal deficit, center's fiscal deficit, and local government's fiscal deficit, the number will become closer to in double digits. In such a scenario, we are interest rate takers. We are not interest rate setters. Whatever happens in the West, we have to follow it. And if we have to follow, then it means that things are not in our control. Things are not in our hand. And imagine your margin, as I said, was 10%, whilst your interest rate from 8% jumps to 12%. What happens? Bingo. Your positive carry, your positive spiral has all of a sudden become negative spiral. So kindly just avoid any leverage into the balance sheet. Three important things, three key takeaways from this entire talk. First, when you're investing in equities, be prepared to see mark-to-market losses, because that's the only way you will remain unperturbed, you will remain calm when markets will be volatile. Remember, when everybody is getting in, you should get out. When everybody is getting out, you should get in. That's the simplest way to make money in equities. That's one. Second is, follow the EPS, follow the PAT, follow the growth in terms of revenue, in terms of profitability, and ROCE, return on capital employed. It's little technical, but return on capital employed means total PAT or total profits divided by the total capital employed. And total capital employed basically means debt plus equity. So in our companies, there is no debt, so hence divided by the equity. So return on equity or return on capital employed is equal, and that should be in mid-teens. So that's the number two. Number three, invest in businesses which are unleveraged, which have dominant market share, which do not have any political connectivity, bureaucratic connectivity, or related party transaction or accounting challenges. If you invest looking at these, you will never lose money in Indian equities. In fact, a 3-year, 5-year, 7-year, 10-year, at least you should make 2 to 3x of the inflation. And equities will remain as the only asset class which can outperform the inflation. Rest, even real estate, will only end up matching the inflation, including gold, including debt. So the post-tax yield across any other asset class will only match your inflation or marginally beat it. Equities, quality equities will remain the only source by which you can create wealth. The thing which is needed is patience and acumen. You don't need to be perplexed. Plus, follow these 3 or 4 key thumb rules. I'm repeating again: B2C businesses, dominant market share, unleveraged balance sheet, and lowest in the consumption pyramid. If you're there in these businesses, you will never lose money. You'll never lose money. You will actually de-risk equities, making potentially very high returns, but reducing the risk in equities.
Okay, I see one question from Rahul. His question is, I bought stocks for years. I don't know how to track whether they are doing well or not. How do I find out? So his question basically is, he's been buying stocks for a long time, but he's not been able to figure out how to track them and wants to understand what, according to you, is the best way to track them.
So very, very simple. While investing in equities, please do not track the stocks on a weekly basis, monthly basis, or on quarterly basis. You need to track your businesses only on a half yearly, and if you're not interested, do not bother. Only track your stocks on a yearly basis. And what you should do is very, very simple. 31st of December, everybody is on a holiday, or 31st of March, when you're forced to compile all your books of accounts, just do a very simple exercise. How companies make their balance sheet, just make a net worth statement, very simple net worth statement. List down all your assets, list down all your stocks, their closing prices on 31st of March, and list down all your liabilities as well and their values. While tracking it from 31st of March, if you have the previous 1 year data, you can just put it, and you can put the benchmark as well. And if you are able to do that for 2 or 3 or 4 years, you yourself will know that these are the businesses I should weed out, and then find an opportune time which you should weed out. So ideally what I'm trying to say is, businesses which are doing well, let them grow, let them do well. Don't cut your fastest horses. Businesses which are not doing well, figure it out just by reading some recent reports. There's so much of news all around. Just find out if the reason for the fall is temporary or is systemic. Have you bought a cyclical stock, or have you bought a leverage stock and the leverage is only building up? Have you bought a stock which is increasing its growth rate way too fast? So you should be scared if a company is growing at a rate of 50-60% year on year. Because if the Indian economy on an average basis is growing at 6-7%, add the inflation to it 5%, and if the Indian government or the Indian economy is growing at a rate of 11-12% nominally, do not see if businesses are growing at 50-60%. It's a big red flag. It's a big red flag, which means they are doing something which is not sustainable, and hence exit. So very simple to monitor it on religiously. The way you file your income tax returns, the way you every day brush your teeth, every year, sacrosanct, you have to monitor your portfolio value as of 31st of December or 31st of March. Better to do it on 31st of December so that you can adjust, do a better tax planning, depending on what to exit, what to buy, what to sell. So you have a 3 months window. Do this exercise on a yearly basis, and if you're not able to do it on a 31st December, please make sure that every year you should do it on 31st of March. And if you are able to do it, trust me, you will create wealth at a much, much faster pace than even Nifty. The bigger problem is people have either two kinds of facets. One, either you monitor it on a daily basis. So some people monitor it on a daily basis, on a 3 times, 5 times. Some people start trading because of that. And then there are other set of people who just hold it for hundreds of years. Markets are dynamic, businesses are dynamic, environment is dynamic. Your money, monitor at least once in a year.
So, Siddharth, I'm looking at a few questions that have a common theme, right?
Sure.
I see questions from Dhara, Aditya, multiple questions, but one common theme is basically, what about companies with, debt? Like, should we drop them completely? What's your view on that?
So I would suggest, please drop them immediately. And the reason why I'm saying so is, again, I'm reiterating. Can you guarantee me that their cost of interest, their cost of borrowing in today's environment? I'm giving you a very live example. RBI has cut interest rate twice after the pandemic. Twice. Your LTRO is available at 4%. Your repo is available at 4.4. Ideally, banks should borrow money from RBI and should lend. The challenge is banks are parking their money with RBI on the reverse side. So whenever there will be a crisis, whenever there will be a problem, the credit will dry up immediately. RBI and everyone will try and push the interest rates lower. Why? It's because of the fear in the market, because of the trust deficit in the market. The cost of borrowing in these businesses jump, whilst the market margins do not jump. In fact, during tough times, the margins tend to shrink. So you have a double whammy. Your cost of borrowing is increasing, your margins are reducing. Would you want to be in this business? You want to make money, right? Are you falling in love with your businesses, or are you want to make money? There's a simple methodology. By owning businesses which are unleveraged, why you want to buy into debt? And interestingly, I'll give you one very interesting analogy. So India has approximately 5,000 plus listed companies in India. 5,000 plus listed companies in India. This includes BSE and NSE together, and I've removed the overlap between both of them. We have more listed companies in India as compared to even US. The interesting part is, over a 10-year period, 75% of these companies do not even outperform the inflation. 75%. In CAGR terms, if I take the inflation and if I take their stock price returns over a 10-year period, they don't outperform. One simple thing which one can see, every 10 years, 30% of the Nifty companies, by the way, Nifty companies are the biggest companies in the country. They are top 50 companies in the country, top 50 businesses in the country. Every 10 years, 33 or 1/3 of the businesses go out and new businesses come in. If leverage would have been so great, why would companies die? Most companies die because of the excess leverage. Most companies die because they take the leverage, but they don't know how to ensure how to put leverage to use. So kindly avoid any businesses which have leverage. That's my simple recommendation. It's not about growing your money. First, preserve wealth. The first rule in equity markets is, so there are only 2 rules in the equity markets. First, do not lose money in equity markets. And the second rule is, kindly refer to the first rule again and again whenever in doubt. Because the first thing you have to do is to make your money protect from the external environment. Once you have protected, so your downside has to be protected. And if you have protected your downside relatively higher, and as Satyan said, that his portfolios have outperformed the benchmark, that's the first success. Then comes the growth.
So Siddharth, one common theme again in about 4-5 questions I've seen is that whether it's about mutual funds or stocks, is that everybody has seen some losses due to coronavirus, and they wanted to hear your view around what you expect. What do you think people should be doing as right now as a strategy, looking towards the next few years as they invest?
So very interesting question. So it will be a little long answer. So bear with me with little bit of patience. So first thing, it's not that the world is seeing the pandemic for the first time. Every 250 years, a pandemic or an epidemic hits humanity. The first one in the known history, human history, has been 350 BC. After that, every 250 years, initially, most of the pandemics and epidemics used to be with plague. After that, viruses came into existence, and maybe viruses may be existing earlier. We don't know about them. In 1889, we knew about viral infection, and which was massive. And after that, there was in 1918, which was the mother of all pandemics. And very interesting thing happened at that point in time. That pandemic, and listen to these numbers very, very carefully, guys. In 1918, the world population was 180 crore, 180 crores. Today, the world population is 760 crores. At that point in time, 50 crore infections happened. Today, we are closer to 33.5 to 34 lakh infections which are there. At that point in time, and this is as per the CDC record, CDC US, 2 crore people died. 2 crore people died. Today, we are in just above a lakh. That's about it, right? Back then, this pandemic lasted for 2 years, from Jan 18 to December 19. And US economy actually posted positive growth in 1918 and a flat growth in 1919. Dow Jones was up at that point in time as well. And today, in the current pandemic or in the current COVID situation, the numbers are very, very low. And since numbers are very, very low, the impact of it on the businesses will be relatively lesser. So that's one part. Second, in 1918, the manufacturing constituted closer to 50% of the total world GDP. Agriculture was closer to 45% and 4 to 5% was services. Today, 63 to 64% comes from services, the world GDP. 6% comes from the agriculture, and balance 30% comes from manufacturing. Manufacturing has been hit, I agree. But services, barring 2 or 3 services, which is aviation, hospitality, hotels, travel and tourism, rest everybody, you, me, everybody, we all are working and adding to the GDP. Even the Q team is helping you out to understand it's adding to the GDP. At the same time, agriculture is contributing. So I don't see the impact will be very, very tremendous, but yeah, next 2 quarters we can see a very, very sharp decline, very, very sharp decline. So that's one part of the story. So underlying economy will have little challenges, but let's talk about your stocks, because that's the specific question on the mutual funds, on the stocks. So in the earlier discussion, I mentioned that there are 3 things which drive the markets. There are 3 things. 1, EPS, PAT, profit after tax, earnings, whatever word people use. The second, PE, price to earning multiples. Higher the PE, higher the market capitalization of the company. What does P reflect? P basically reflects the future earning potential of the company. And the third thing, liquidity. Liquidity means the money which is chasing these equities. Now think about it. I agree that the broader earnings will have very, very tepid growth or may have negative growth in next 2 quarters, only for 2 quarters. They would have future outlook, which also may be a little bleak. But let's talk about the liquidity. And I will again use some data points here so that you can get the context. And it's very important you should understand this context so that then you will know. First, in 2008, and I'm coming back to 2008 because 2008 when we actually saw an economic meltdown. At that point in time, the size of the total subprime problem was closer to $1.2 trillion because it was bundled up, it was collateralized. So the CDOs, the CBOs, the collateralized bond obligations, the collateralized loan obligations, collateralized debt obligations, the total problem became $4 trillion. So I'm repeating the numbers again. To $1.2 trillion was the size of the problem, but it created an impact of $4 trillion. The size of the US economy back then in 2008 was $14.5 trillion. And I'm just comparing it with India's economy. Today, we are an economy of $2.8 trillion. In 2008, we were $1.35 trillion. So Indian economy in last 11 years have doubled. So from 2008 till 2019, we doubled. 1.35 became 2.8 approximately. And US economy from 2008, which was 14.5, has become $21 trillion. So clear 50% jump there and 100% jump in the Indian economy. When the size was $14.5 trillion, US gave a stimulus across 2008, 2009, and 2010. Across 3 years, $2.4 trillion was the total stimulus which was given by US across 3 years. Today, a $2.2 trillion of direct stimulus plus indirectly all the stimuluses given together from US government and Fed directly or indirectly constitute $6.6 trillion, guys. 1/3 of the economy has already been pumped into the market. On top of that, they are talking about $10 trillion by the end of the COVID. So imagine $21 trillion, $10 trillion stimulus, which potentially can come into the market. Where would all this liquidity go? Either you will consume, you're not going to start new businesses during this time. The easiest way is to buy and own quality businesses. And that's where the money is going to be chasing. That's one part of the story. The second part of the story is interest rates in Europe. Interest rates in Europe are negative. Interest rates we saw yesterday also, they remain unchanged. So 0 to 25 basis is the interest rates in US. Doesn't it make sense for the large institutions to borrow at 0 to 0.25% interest rates and invest into the emerging market risky assets and even earn 6, 7, 8% dollar returns? Phenomenal. So there's a huge leverage trade which is happening in the West where the money is coming in India and being invested in India. And that's the reason my reckoning is that the underlying economy may remain little weak for next 2 or 2.5, 3 quarters, but the stock markets aren't. And if you have owned right kind of businesses, you don't have to worry. You will see recovery very sharp, very fast. The only thing you have to do is be in the right kind of businesses. So as I mentioned, look for whether you own the mutual fund, go into your mutual fund portfolio and look at the businesses which are owned by these mutual funds. Do they have these characteristics? Unleveraged, B2C, dominant market shares. So if you have these kind, do not worry. And let's assume even if you do not have, because some people may have a mid cap or a small cap kind of a portfolio, if you have patience, stick with it for a period of next at least from here 24 months. If you don't have that kind of patience, exit now. In fact, when the recovery is happening, which happened in the month, because we saw massive outflow in the month of March. In April, large part of the FII money has come back. Almost 60 to 70% of the FII money is back. And if you can see that small caps have outperformed the large caps, mid caps have outperformed the large caps, the small caps have outperformed the mid caps. But this is temporary. If there is a second leg of correction which will happen, small caps will get beaten down. So you have to be very patient. And as I mentioned in my first thing, when you're investing in equities, remember that volatility is bound to happen. It's endowment effect. Because your market value is eroding, you're feeling that, oh, my principal is getting lost. No, these are notional losses. These will get recovered. Only thing is, don't pick dabba companies. Don't pick companies which do not have any credibility. Just that's the honest record. If you have owned reasonable companies, reasonable mutual funds, stay put, stay invested, and you're going to make lots of money from here. These are the times which comes once in a decade. These are the times. And if you invest in these times, you can potentially have at least 1.5 times or 1.5x returns as compared to the normal times. So just stay invested.
Let me tell you something about, what is our criteria for selecting a fund and what goes on in this whole process. The first thing that we see is the AMC comfort. When there's a name called Sahara or a name called DHFL, we don't even touch it, irrespective of performance. So for us, AMC comfort, the pedigree, the credibility of the promoter, and is extremely, has to be extremely high in our system. Again, then the compliance and process to ability to retain talent, because a lot of fund managers keep shifting from A to B, B to C. So that's one thing that we'd like to see, that the AMC retains talent, because a lot depends on the fund manager. The next is the fund manager comfort, the experience, the reputation, the performance, the consistency is what we look at. We also evaluate schemes based on parameters like fund size. If the fund size becomes too big, then it becomes a little difficult to manage. And then there are certain technical things which I don't want to get into, but I think last is a factor that we look at, and it's last. That's historical performance. But for us, consistency scores. So we look at evaluating underlying portfolio exposure, like the earlier gentleman mentioned. What's the composition of the portfolio? Finally, before recommending a fund, we definitely would meet, at least 3 or 4 of our partners would meet the fund manager and the CEO a couple of times. So, so these are broad parameters, but finally, we look at what the client wants and then try and select an equity product. On the debt side, the same things, the AMC comfort, the fund manager comfort, every paper is scrutinized by one of the partners, because we guys have a debt background. More experience than us partners. So ultimately, every debt fund is approved by partners who cumulatively have 250 to 300 years of experience. So Satyan, like you asked me, this is the way this is the input that we give before.
Hi, I would love to have you explain a little bit of the magic you guys do. For example, you said you did not recommend Templeton. I know you guys.
I did not say we didn't recommend Templeton. Okay. I said when we started seeing that they were getting a little greedy. 1.5 years, 2 years back. I was incidentally also involved in the setting up of Templeton in India.
Okay.
So I have a lot of respect for Templeton. On the equity side, I think they are one of the best, one of the most consistent. They messed up big time.
So can
And
you
when
tell
they
us a
started
little bit more what you mean by you saw them getting greedy? Because I think that's the interesting part, which us as novice investors don't know how to analyze or track. What did you see which made you say these guys are getting greedy?
Well, the way I look at it is, there is a fixed income, and then there are the risk assets, which are equity, real estate, commodities, and whatever.
Right.
But on the fixed income, if your mandate is to preserve capital and earn a return which is commensurate with the yield curve. I mean, you have a yield curve, which is the Government of India 10-year bond, which I don't know if anybody knows, but you can an individual can buy 5,000 rupees worth of G-Secs also. Okay, there's an auction every week. Then you have the state loans, then you have the PSU bonds, then you have. So the idea is to make money on the yield curve and to earn a little bit more than government securities, earn a little bit more than, but if you are trying to replace a bank, when a mutual fund tries to do what a bank is supposed to do, which is credit lending, without having the expertise, that's when you start going wrong.
Right.
Promoter funding was traditionally in the banking circuit always at 14, 15, 16%. Mutual funds started lending.
So Premal, see, in the cube system, we constantly see from you and Kruti in your team, changes in what are the recommended mutual funds, right? So you sometimes tell our customers that now we are not recommending these, we are recommending a new set. As you said, you look at promoter holdings, you look at whether mutual fund managers getting greedy. Very curious to know, is this public information that you guys, just with your years of experience, know how to look for? Or is it private information through the rumor mill that you hear about?
I think it's 10% of private information, 90% is public information.
Okay, that's very heartening to know that it's not just biased towards the big boys, but 90% public information also. You guys know what to look for, right? Like somebody like me wouldn't know what to look for in what are the key things inside each fund house.
No, I mean, we are doing our job. Let us do our job. Yeah, you do your job.
Very true. Very true. Yeah, and I think it's again pointing out how people think it's so easy to invest, not realizing that investing by itself is not the end goal. Making money is the end goal, right? When you invest.
And when you lose money, there's nothing wrong in losing money in equity.
Right.
I feel very strongly when you lose money in debt, but when you lose money in equity, there is nothing wrong.
Right.
I mean, it's all the market. I mean, as long as you're in the right product, you're in the right mutual fund, you're with the right fund managers, and you're with the right advisors, there's nothing wrong in losing money.
Right.
But that's with the markets going up and down. Who knew this virus would have come?
Yeah.
And nobody in this world knows what's happening.
Absolutely. I think you nailed it, right? Why do you touch anything debt? Because debt is in the same category as leaving it in your bank or FD. There, you want a little bit. You
are supposed to deliver FD and government security plus returns.
Right. Exactly. And losing capital is not an option there, because if you were willing to take that risk, you would send it to equities instead.
Correct.
Right.
Having said that, you can go wrong sometimes where there is a fraud, like ILNFS.
Right.
What's a AAA? I mean, so you depend on the credit rating agencies that it's a AAA, but when they falter, you can't help it.
Right. Oh, that makes sense. That makes a lot of sense, and it's a lot of these little insights, which I know I get calls from my wealth manager 10 days before it hits the open market saying, sir, do you own any of this? Get out of it, right? Which always makes me think, wow, there's so much I don't know about this space in mutual funds, wealth management, etc. And it's better to have somebody. Premal's back.
So
What
I
was the
think I'm
question?
gonna-
The do's and don'ts for mutual funds, Premal. Common mistakes
Common
people
mistakes.
make by going off ratings and last 1 year track record. What are the most common things you've seen in your experience that you should avoid?
One is, of course, like I mentioned, you must have an advisor. Number two, do not listen to friends, family, and part-time advisors. Because friends, my experience is friends, families, part-time advisors only talk about the good things that they've done or they've achieved. They never talk about the losses that they made. Lastly, I think look at advisors who have a proper research, who are not a one-man or two-man show, and look at people who have experience. And look at people who put their money where their mouth is.
Yeah, no, that makes sense. That makes sense. I think it's one of those classic things, mutual funds, guys, to the audience. The problem is everybody understands what a mutual fund is. It's not like PMS, equity advisory, alternative assets. And because I think everybody understands it, Premal, people think it's easy to pick because there's every flavor available. There is billboards, there's radio ads. I think that's almost like Amphi has done a disservice by saying mutual funds sahi hai. No, that is not enough. After that, what do you do? That is the big part that has been the missing equation. And everything was great.
And they also went about advertising the direct option, whether it's SEBI or Amphi, I don't know who.
Right.
Most stupid thing that they could ever do.
Yeah. And guys, to the audience, I would say this is not because Premal is an advisor. It's a very simple, logical construct. Sure, direct saves you some percentage in commissions that the intermediary makes. And if you're getting nothing for them making the commission, sure, avoid the commission. But here we are talking about a very complex asset, which on the surface seems simple, but the complexity is what's happening in the market with that particular asset, companies they own. If you're getting quality advice, why would you not pay whatever it is from 0.2 to 1% to enhance the chance that you make money? So even at Cube, we have been big believers saying experts need to be paid for their expertise because your goal should be to make money, not to reduce the amount of fees you pay, right? And that's why we are very proud that we've kept it tied up with Wealth First from day one of our launch.
Yeah, so there's a question here that I had about, if you could talk a little bit more about credit risk with what happened with Franklin. What do you foresee in the future? Do you think something similar may happen? Are there more such things, lined up for us in the future, considering the pandemic and your expectations basically from what you foresee?
Well, I have no idea about pandemic, what's going to happen in future. I think banks have a certain role in this financial market. Mutual funds have a certain role. And if mutual funds try to enter into the bank's territory, which is the lending, which is the credit business, that's when you have problems. And when you have credit rating agencies not doing the job properly, the same thing can happen. And a lot of advisors don't understand that market. They get cornered by the marketing people. I think even fund managers are now become marketing guys and not fund managers. They get overawed by the fees that credit funds give. And they all went wrong.
This is loaded advice, and a lot of Premal is a dear friend. Many people in the audience are personal friends as well. I think the key takeaway whenever I get pinged by somebody on what to invest, I remember Premal's words saying, if you're talking about the debt side, stay conservative, right? You're not out there to make the extra 1%. You're going to make sure in your debt portfolio, your money, the core capital stays safe. You cannot risk that.
Right.
This is such a fundamental principle that people don't understand when they buy a debt mutual fund, which might give you 8.5% versus leaving in the bank for 6.5%. Why do you want to take that risk? If you want to take that risk, really roll the dice for equities. Huge learning for me from just that one simple concept. And the flip side of it, what Premal you said, which is, hey, there are quality companies like banks like SBI, HDFC, which also issue bonds. If you trust your money in the FD, it's not a far stretch to say that these top tier brand names, you can trust their bonds as well. That's when you should optimize and say, I can go for 9.5%. And these are factored in some of the high quality debt mutual funds, etc., that some own some of these bonds as well. So it's a huge.
If you and I buy SBI or ICICI perpetual bond, which I think it's not a credit risk. So if I buy something at 9,
yeah,
on my own, and the yield goes up to 10,
yeah,
for me it's not a loss, because at the end of the day I'm going to get my 100.
Right.
But if a mutual fund invests, for him there is a mark-to-market concept. You know, there's a word which is mark-to-market, which banks and mutual funds have to follow.
Right.
Continue SIPs in equity fund in the current scenarios, or pause until the market stabilizes? So Satyan, I think this is a question that we've all heard at some point. We've kind of wondered ki main kya karu, right? So why don't you talk a little about the way you looked at it till we talk to get Mr. Mehta.
This is for equity mutual funds, right?
Yes. The question is, should I continue my SIPs?
Yeah. Look, it's a very simple principle, right? If you follow the perfect portfolio construct, you're not putting anything in the equity market for money you need in the 0 to 3 year time frame. For 3 years plus, you do buy equity mutual funds according to the cube philosophy. If you really believe that Corona is going to be around for 3 years and the Indian market is really, economy is not going to pick up for 3 to 5 years, then sure, stop the SIV. But I don't think anybody has a crystal ball to look that far out. We as a species are generally optimistic, and that's why we invest in the equity markets. So then the principle, the philosophy is effectively a downturn in the market means you're getting the same equities that at a sale price, because you're thinking 3 to 5 years out. Right? So why would you stop your SIPs? In fact, at this time, start an SIP. And if you have one, definitely continue it. It's like saying 30% off for your favorite brand. Nay, I don't want those clothes because they're 30% off. Who does that when you apply the retail example? So definitely continue that. In fact, people have been pinging us saying, can we add more money right now? Should we add it all at one time? Should we split it over 2-3 months? We don't have the answers for that, but because that's a personal choice on risk versus reward. But for sure, for SIPs, how do you discontinue equity SIPs? 100% you shouldn't be.
What we've been telling our clients as of now, and is that you don't know where the market is going to go. You surely do not know how much down it can go. But there's one thing that we are very certain is that if there is even a sign of a discovery. Hello, can you hear me?
We can still hear you.
So even if there is a sign of discovery, you will not get to buy stocks again. They'll just zoom. So what we're telling people is that stay invested, a lot of our clients have asked us that should we put in more money. So we've been saying that if you have 100 rupees, put in 20 rupees now. But have the ammunition in place to invest more if the markets fall.
How do I know that it is time to sell, even in the future? Like what are the things that you look at when you tell someone, yeah, right now it's the right time to, sell off this fund or switch to a different fund, whatever their advice is?
Well, right time, I don't know. Okay, because we missed that phase.
You know what I love when I speak, and again to the audience, right? When 2016, when I started evaluating wealth managers, there are people who have all kinds of theories and gyan in wealth management. They will come and talk to you for half an hour, 1 hour about how the price of crude and what's happening in China versus US versus Trump will affect your portfolio. And then there are the few exceptional ones who say, I know this much, the rest I don't know, right? That's courage to say, I don't know. I know what I do. And I think from this session, Premal has clearly indicated why the things he and his team are really good at and the things they don't know. We don't know what's happening in the future. We don't know whether you should sell a particular fund right now or no, right? But right now, overall, don't sell. The rest we don't know. And anybody who pretends otherwise is just giving you hogwash to try and close a sale. So this is one of the classics. And it's funny, the book, the support I'm using to prop my laptop up is one of the classic books in investing. This is Charlie Munger, who's the partner for Warren Buffett. And the beauty about these two gentlemen, who are, by the way, in their 90s, right? So is that they're very publicly spoken about their investing philosophy to everybody who will listen. There's no secret sauce. And it's such a simple philosophy. The problem is most human beings cannot stick to simplicity, especially in investing. Do you have any closing words of advice you wanted to give us?
There's nothing more that I can say. The only thing I like to reiterate is that always have a good advisor in place. And when you trust an advisor, you trust him right through, whether he may go wrong. There's nothing, we've gone wrong. But point is, trust somebody who's got experience, trust somebody who's got knowledge. Look for structured products. Be very simple in investment. Investment is supposed to be very simple. What is complicated is business. Okay. Investment of your surplus money has to be very, very simple.